Shares of Affirm, interestingly enough, are down nearly 6% and on pace for their worst day in about 2 months. Here to help us trade these names and more in the news right now is Tim Seymour, the CIO at Seymour Asset Management, a CNBC contributor. Tim, what's interesting to me, I mean, it makes sense that the credit card names are down, but I thought buy now, pay later might be in the green and say, well, this is a competitive advantage for us.
Seemingly a place to kind of fill in the gap, but also I think the extension of credit overall is something that people worry about. And that's really, where do some of the buy now, pay later folks come into play? I mean, I think, especially when the advent of this being the new, way of financing, there was some sense as rates went higher, it would hurt them. No, not necessarily. It's really, to me, if you reel in credit, becomes that much more competitive. And I think it may be an environment where they're not the last dollar.
Would you pick up any of the credit card names on the sell-off? If you were in the camp of saying, well, let's see what the proposal really is, or do you think that it's enough to know directionally there's going to be some political pressure here and to stay away?
Well, I think we have history of showing it was a great buying opportunity for buying the late fee, the news and headlines that we had recently. And I think if you look at banks overall, a Citibank's overreaction today is just that. Whereas I think if you look at a Capital One, if you look at the Synchronies, some of these are a little bit more tied into. I think what's most interesting about these headlines for the market is they are coming after an extraordinary period for these names, and especially for the money center banks. And we're about to have a big reporting, and I think it's kind of obvious. The reason why it's, for me, I can own a 14 to 15% EPS growth in the banking sector, which is the best we've seen in a while, with all the other tailwinds, is because I believe they should trade at a higher multiple based upon the world we live in, which is a world of deregulation. And of course, the last 2 weeks have not been a world of deregulation. So at one point, 8 times or 2 times price to tangible book for money center banks, it was easy to say on a historical basis, they're kind of expensive coming in. JP Morgan at 3.2, Citi the other end at 1.3. I like Citi here. I'm long Citi. I think you're buying weakness. I think obviously yield curve, both being steeper, net interest income, investment banking fees, M&A bonanza. I like the story, and I think weakness should be bought.
They have a lot of the Citi, Wells, sounds like you're saying any of the big banks have the big bank story, which is still a deregulatory one. But it is ironic, to your point, that every populist move is effectively a re-regulatory one.
Yeah, they have been. I think the buy now, pay later, and I think the deep part of the credit curve, in other words, 10% cap makes a lot of these businesses not profitable.
All right, let's move on to the metals. The gold trade, again, new highs today. I forget if you've told me if you love all of it or just part of it, or if you think the whole thing is looking crazy.
I love it all.
Okay.
I've loved it all for a long time, and my emerging markets background has been about central banks diversifying. I mean, China at 7 to 8% gold reserves. Compare that to Germany, that's 80. Italy, 75% of their reserves in gold. So I'm not saying it has to get there, but that alone has been the story.
Wow.
Venezuela and Fed probe are not. They're not the cake. That's icing on the cake. The story around gold, to me, is an asset class allocation. It's weaker dollar, yes, less Fed independence are big ingredients, but this is a secular trend that's been going on. Gold is the best 25-year chart of any chart you can find, and I have enjoyed this chart.
But even when it gets to the point that we're talking about icing on the cake, do you even think that, okay, there's got to be some kind of pause or reset here? Or, you know what I mean? Like,
well, when you're putting icing on a cake, Kelly, I know you know this because I know you bake a lot. I mean, you're almost done. And I don't know that that's a fair metaphor here, because I think gold is going to be 6,000 by 28. I think there's deficit issues for gold. I think there's an asset class allocation that I bet a lot of the big investment advisors, money center banks are going to say that they have a gold allocation that's maybe 10% or more.
Right.
And that's something that gold hasn't even experienced. So I like this trade.
I buy a lot of cakes.
Yes, well,
that said,
that's also good.
That's also, well, not as good. For the rest of the metals, though, and I totally take the gold point, when you talk about silver and copper and platinum and palladium, are they being dragged higher by the gold price? When you look at them all in the green this morning and you say, well, did we get a new data point on electrification? Did we get a strong GDP demand point that would help them? Or is it simply gold goes higher and it pulls them up as well?
No. I mean, precious metals have worked now for 3 years, and copper didn't work until October. Copper works because not only data center and EV demand and grid build out, which was a story 3 years ago, let alone now, supply deficit, Indonesia, Grasberg mine for Freeport, everywhere you look, geopolitics, copper hoarding, strategic asset dynamics of copper now that weren't there in place.
Yeah.
And I think if you're investing in copper miners like Freeport or Southern Copper, and I am long them, I'm long in my ETF.
Yeah.
the underlying copper input prices in these names have to be upgraded by analysts, which means the share prices have to be
Keep
upgraded.
going higher.